Welcome to This Week in Money. I'm Jim Goddard. Today, Bob Hoye from chartsandmarkets.com runs down the major markets. He points out the S&P 500 had its worst half of the year since 1970. He comments on gold, the US dollar, and how the crash in cotton could hit other commodities. Publisher of the realestatetiming.com newsletter, Robert Campbell, talks to us from San Diego about the U.S. stock market, real estate, the chances of recession, and how to keep your financial head above water. He also gives us some fitness tips. WolfStreet.com publisher Wolf Richter checks in from San Francisco to chat about interest rates, inflation, cars, supply chains, and the continuing chip shortage. Plus, at the end of the show, we'll have a company showcase update from American Manganese CFO Shaheem Ali. We'll talk to Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to This Week in Money, Bob.
Yeah, Jim, good to be with you and with our listeners.
The Standard & Poor's Index, its worst 6 months of the year since 1970. Has that been the whole story for all the stock markets?
Oh, yeah, that's the investment grade set of stocks. It's the Standard & Poor's 500 Industrials. It's a very good index. And then you've had the radical sectors, the key cryptos and Bitcoin and all those sort of things. And then earlier today I looked back on the fad of a few years ago, which was the marijuana stocks, where everybody was happy with the marijuana stocks. And one of them, the symbol was weed, W-E-E-D. And it's just been straight, just all the way down. Just a sad story to see.
Bob, what's going on with crude?
Yeah, it's been sort of rallied up here recently, and it had kind of a setback day to day here. Commodities have become vulnerable. You know, the story for the last few months has been that the 1970s type of inflation is back. Governments in Ottawa and Washington, D.C. have been ranting and raving about it. But there's been some reversals here. And just let me bring up the cotton. Yeah, because this one was quite interesting to look at the chart as we're talking. Now, it soared up to $156. Now, cotton is a really big global product with a huge contract. So towards the end of May, it was at the 145 level. And then after the contract crashed, I looked back on it, and there was at the end of May, an article pointing out the bullishness for cotton because the assessment of the crop in India was not looking good. And then, so for the first 2 weeks, cotton rallied it down dipped at the first of the month, and it rallied from 134 up to 147. That was on the 12th, so high intraday 147.70. The next day it traded down to 120, so it was more than 30% down in one day. So there's no real liquidity out there. Now, since then, and keep in mind that in early May, the high was 156. The low a couple of days ago was $91. I mean, that's a slaughter. But the instruction is that there's also other big commodity. If this big commodity is that vulnerable, other commodities are as well. So for an old-time market historian like myself, it's fascinating. And I think the message is that It's the loss of liquidity. Now, when the crash occurred, I looked for some headlines there. This was after the crash, because I wrote it up after the crash. And it was a sudden slowing down of demand for yarns and threads and all kinds of things. So all of a sudden, the further out buyer of cotton products was just gone. So we'll see what happens with other commodities, and we'll watch cotton for a while, mainly because it's so dramatic.
Bob, what's happening with something that really is old and historic? Gold.
Yeah. Well, let's keep in this trading range here for a while, but the whole gold sector is getting set up for what could be a multi-year rally. We sort of specialize in the gold sector, and in 2020 was the last really good rally, and it rallied up until July in 2020, where it became very, very overbought. And our advice was people would take some money off the table. And then what has happened with gold is that in the final stages of a big, fantastic global financial bubble, the gold sector doesn't do well, and it didn't do well. And then making it worse is that when the big bubble fails and the senior stock indexes go down, it takes out the gold stocks with it. So, but in our special work, the gold sector is depressed generally, and certainly on the small cap exploration side. But it looks like this thing could create a bottom sometime over the next couple of months, and we will then have our technical work. Hopefully, we can identify the week when we would want to buy, and that is sometime ahead of us, but it's worth keeping in touch about.
What's going on with the U.S. and Canadian dollars?
Well, the U.S. dollar, firm again this week, and again this comes back to what happens to the senior currency in a post-bubble contraction. And typically, the senior currency goes up, and the U.S. dollar is rallying. Early in last year, it gave it built a base in the first half of the year. At 90 level, 6 months base, and then we thought, hey, that's constructive. And then when it broke through 93 on the way up, that's what we call the DX. We then had our target of 103 in that range, and in May, under the worst of the panic, the U.S. dollar index got up to 95, where it was very, very overbought, and then it sold off, to about 101.5, and now it's around the 104 level. It could, if further financial pressures hit the markets over, let's say after August is the time when people can start discovering that there's a lot of bad stuff out there in the marketplace, then the dollar could rally, and who knows, something like 120 is possible. So let's put it this way, breaking above 106 for the dollar index, it could reach about 120, which it's going to surprise a whole lot of people.
Bob, thank you so much for chatting with us.
Yeah, Jim, good to do the wrap at the end of the week, and we look forward to talking to you next week.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. Coming up, Robert Campbell next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter online at realestatetiming.com. He's speaking to us from San Diego. Bob, welcome back to This Week in Money.
Thank you, Jim. It's a pleasure to be here.
When is the next issue of the Campbell Real Estate Timing Letter going to come out?
It's going to come out on July 15th. I'm starting on it right now. It's published once every 2 months, and it My real estate timing letter tracks, let's see, about 25 different housing markets, and major housing markets in the United States, 6 of which are in California.
Does your book, Timing the Real Estate Market, cover rising interest rates and the effect on home prices?
Yes, it does. And it's so interesting you bring up that topic, because of the 5 key indicators I identify in my book, Timing the Real Estate Market, which I put together in a model that predicts major turning points in housing markets with a success rate of about 80 to 90%. The least predictive of all those, the 5 indicators are first. Let me name them first. Existing home sales, 1. 2, new home building permits. 3, mortgage defaults. 4, foreclosure sales. And 5, interest rates. And of all those 5, the least predictive is interest rates, Jim. Least predictive. And that's the one that's focused on the most out in the marketplace. Gee, interest rates are going up. That means housing is nearing a turning point. Wrong. Interest rates are coming down. That means housing is nearing a bottom. Wrong. But it is valuable, but it's not the most valuable indicator that I follow.
With midterm elections coming up in the U.S., does it look like the Federal Reserve will continue to raise interest rates or just let inflation grow, or both?
That's an impossible question to answer, and it's strictly my opinion, and based on the past, it's my view that the Federal Reserve will raise interest rates to a point, but they're not going to raise interest rates enough to kill inflation, but they'll be raised enough to put the U.S. economy into a really nasty recession. So what we're going to have is stagflation, which is just killer.
Wow, so the wrong kind of sweet spot. It'll do bad things instead of helping out at all.
Things.
Yeah.
Well, and the key to all this is, and whether you're operating on a macro level in the government or on a micro level with individual households, there's so much leverage in the system. There's so much leverage in the system that's where everybody's going to get hurt. And interestingly, even though the U.S. the national debt is $30 trillion, and a lot of people mistakenly think, wow, if they raise the Fed funds rate, up to a point where it kills inflation, which is typically, 3 to 6 percentage points above the rate of inflation, the interest on the national debt is going to triple, and that's wrong. It's not going to triple, because the average maturity on the average U.S. Debt security right now is 62 months, which is 5 years and 2 months, and that stuff's already on the books. And that stuff's being carried probably at an average interest rate of, let's say, between 2 and 2.5%. So that's going to stay there. The only thing that's going to change if the Fed jacks up interest rates above the rate of inflation, and let's say that, federal fund rates goes up to, let's just say 12%, and, the 10-year goes to 5 or 6, and the 30-year goes to 6 or 7, those new higher interest rates are what will be applied to the new debt, not the old debt. So that doesn't mean that these guys can do whatever they want, because the rest of us, whether you're getting a mortgage or whether you're getting a car loan or whether a business is operating with leverage, everything's going to come to a screeching halt, which is going to increase the rate of unemployment. People are going to get thrown out of their jobs. And here's what's really interesting this time. That during economic recessions, tax revenues take a big tumble. Right now, the U.S. is collecting something like $2.9 trillion in annual revenues and taxes. If we get into a recession, that's going to drop probably down, maybe lose $1 trillion. So let's say we're only collecting $2 trillion as opposed to $3 trillion. The problem lies here, that with the debt service, with the Social Security obligations, with Medicare obligations, the Federal Reserve has no choice but to keep printing money and keep printing national debt in order to keep making payments on those obligations. And so what you get into is a situation where when tax revenues fall, let's say $1 trillion, and all of a sudden now they got to print up another, 2 trillion, 3 trillion every year just to keep the government and the social programs functioning. Now you're adding $3 trillion a year onto the national debt that even though it's, that it's at a higher interest rate and it doesn't affect everything, yet you get into a downward spiral that there's no way out. You can't tax people any more than 20% of their income. You can't. That turns into revolution. You just can't do it. You just can't tax people at that high of a level. And so you get into a downward spiral in order to keep the lights on in the government and keep Social Security and Medicare alive. As long as we're in a recession, they're going to have to print $3 trillion a year, all of which will go on top of the national debt. And so the downward spiral continues. So that you just get to a point that that there's no way out unless you just, allow things to reset, a massive reset of asset values, real estate, stocks, and then let the cards fall where they may. But it's the leverage. You can't get away from the leverage. So that's the key thing. Back in the 70s, when we had inflation, when inflation averaged 9% per year from 1970 to 1980 in the United States, the national debt was less than $1 trillion. Today it's 30 times that much, 35 times that much. So that's the problem. And so let's say inflation goes on for at least 5 years, and it probably will. This thing's not going to be over. This thing's not going to be over like everybody hopes and wants it to be. Let's say it gets to be over 5 years. Where the problem is all of that 5-year debt that, all of a sudden is going to get rolled over at the higher interest rates. It's not going to be 2.5%. It could be 10.5%. Now you have a problem. If it goes on that long, now you have a problem.
How high do you think interest rates could go?
Well, historically, let's look at history. History is the best guide to the future. Back in the 70s, or back in the early 80s, when inflation in the United States got to 13.3%, I think it peaked at that level, Paul Volcker had to raise the Fed funds rate 6 full percentage points above that to kill inflation. So in other words, that Fed funds rate got into the high teens, mortgage rates got into the high teens, and it just devastated the U.S. economy. We had 2 back-to-back recessions that were terrible. And so that's what they have to do. Now, will they be willing to do that this time? That's a great question, and we don't know. And and with the mid-elections coming up, I mean, do we want to see a crashing stock market and a crashing housing market in order to get inflation down? I know the way those morons operate, and the right answer is probably no. So they may back off and let inflation run wild until after the election. And inflation is still increasing. Everybody says, oh, it's peaked, wheat's down 25% from its peak, oil's down 15%, blah, 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 blah. Well, yeah, inflation just increased from I think it was 8.5 to 8.6. So, you can't listen to that stuff. So inflation is a serious problem. It's not going away soon. And, there's a lot of debate on what causes inflation, but Milton Friedman, I believe, had the best definition of inflation that you can use. That's probably the most accurate because it's the most simplest. It's too much money chasing too few goods, and that's why you have inflation. So now we got to deal with it, and it ain't going away, guys.
Bob, are there ways to stop it? Bob, are there ways to stop an impending economic collapse?
Yes, there is. And what I would do is I would revalue gold to $25,000 to $50,000 an ounce, back the U.S. dollar with 20, 30, maybe even 40% gold at the new high price, and that would bring confidence back into the fiat currency, because you get inflation going off at 10%, 15%, 20%. You lose complete confidence. The inflation gets worse, and pretty soon there's a collapse of the economy because people can't keep up with with inflation. But if you back it with a currency, back it with a commodity like gold, there's a good chance you can keep everything going. I mean, it's not a solution, but at least you don't have a collapse of the financial system. At least the bond market doesn't collapse. That's why Volcker had to raise interest rates, to 20% in 1981, because the U.S. dollar had lost 50% of its value from 1970 to 1980, and as the world reserve currency, we were poised to go into hyperinflation. You can't go into hyperinflation with the world reserve currency, so he had to stop it, and he did, and he crushed it. But it took that kind of interest rates. I mean, could you imagine in today's market with housing prices elevated how they are at these levels, which is the highest ever? They're at unaffordability levels not seen since the peak of the last housing bubble. Can you imagine what would happen if mortgage rates went back to the high teens? It'd be a total collapse. Total collapse. Housing prices would lose, nationally, they would lose, over 50% of their value. In fact, even based on my reversion to the mean calculations that I rely on very strongly to predict how far housing prices are going to fall, that I predict that we're close to a peak right now, and that nationally, U.S. housing prices on a nominal basis are going to fall 45% from the peak to revert back to the old long-term trend line, which I call the mean. 45%. A lot of people are going to get hurt really, really badly again. So it's just, and it's the Federal Reserve doing this. That's what's interesting, everybody, is this. Everybody says, during the the run up to the 2006 peak during that bubble, that, mortgage companies were giving away mortgages. All you had to do was fog a mirror. You didn't need to, you could lie about your income, you could lie about your job, you could lie about how much money you made, you could have a crappy credit report, it didn't matter, you could get a mortgage loan at 100%. Well, they're not doing that anymore. These guys, found Jesus, and now you gotta qualify for a loan. Granted, I won't debate that. The difference this time is the Federal Reserve took interest rates down to all-time record lows, down to 2.5%. And that's what caused this bubble. So, it's like generals always fighting the last war. Every cycle has its different dynamics to it. And this one was driven by low interest rates. You take 6% interest rate, at 6% mortgage rate, where somebody with the average American income can afford a $400,000 mortgage, drop that interest rate down to below 3, and now they can afford a $600,000 mortgage. Voila! The price of the house just went up 50%. Did incomes change? No. Nothing changed except interest rates. And just by that's the only dynamic that changed, and housing prices went up to reflect the fact that you could afford service a lot more debt at 3% than you can at 6%, and that's what drove this. And now things have reversed dramatically, where interest rates have gone from 3 back to, let's call it 6, and that's what's going to cause the this crash. It's going to be unaffordability, and we're approaching those levels right now. We're not there yet, but we're damn close. And any of my followers that say, Bob, I know you think there's still more room to the upside, which there is, but I'm getting scared, I guess, go ahead and sell. Sell! You know what? You've made a huge profit. That the majority of your gains have already been made. Don't hold out. If you don't want to hold out for the last 5% or 10%, I'm not going to argue with you. In fact, I'd probably do the same thing. Get out. Especially depending on how old you are. So we're there, guys. We're there, guys, in housing. It's just not over yet.
Do the stock markets look like they're in for a summer rally?
It certainly could be into a summer rally. However, there's no expression in the stock market, sell in May and go away. So you sell in May and you buy back in November. And if you go back historically and you were to follow that simple rule going back 100 years, you would outperform the averages dramatically. So even though you can't use averages, like they say, that river is 100 feet wide and the average depth is 4 feet. So you should have no problem crossing it, right? Wrong. The average debt is 4 feet. There's some areas that are 2 feet, and other areas that are 8 feet. You fall in that 8-foot hole, you're going to drown. So that's the problem with averages. But that in the long run, averages work. In the short run, anything can happen. You can have exceptions to the rule.
What are your thoughts on the U.S. dollar?
I think the U.S. dollar is going to keep going up, and it's going to be because the dollar is normally reflective of monetary policy, and when the Fed raises interest rates, and you can get more on a Treasury bond than you can on a Euro-dollar bond, money's going to flood into the United States. Euro dollars need to be converted into U.S. dollars to buy those bonds, and therefore the dollar goes up. The U.S. dollar is still the cleanest shirt in a dirty laundry. It still is. Europe's in really bad shape. Europe has 8% plus inflation, and they're still holding interest rates down to less than 1%. That ain't going to work. I mean, just from a financial standpoint, let alone their problems with getting gas and oil from Russia. They keep dicking around with that. Pretty soon, Putin's just going to turn off the valve and see how they like that. I mean, that's a reality that they just can't ignore. That you could say, oh, we're not going to do this. Yeah, you're gonna freeze to death this winter. How do you like that? So, that's what's going on over there.
What's the latest on housing markets in California and across the U.S.?
They're both going up. They're still rising. California housing market is still rising. Unaffordability is nearing levels where historically the trends tend to reverse, but we're not there yet. The affordability is still falling. And I know this is counterintuitive, everybody, but falling affordability means higher housing prices. It's good for housing prices. It's when affordability starts going up, that means housing prices are going down, and the market's driven by fear. For example, in California, during the last two cycles, the ones that bottomed in 1996 and in 2012, at the peak in 90 and 2006, housing affordability got in the range of 17 to 12%. Super unaffordable. Then prices started going down. So then housing affordability, fell from in 2006, it fell from 17, it went up from 17% to 50%. In other words, 50% of all households could afford a house. Yet prices were still falling. That's because the market's driven by fear. And most people totally underestimate the importance of market sentiment, of market psychology with respect to any asset class, whether it's real estate or stocks, because it's all driven by emotions, guys. When everybody's driven by fear, driven by greed, and euphoria is running wild, you can drive affordability right into the ground where only, less than 20% of all households can afford a house and prices can still go up. When it's driven by fear, on the other hand, and despair, housing affordability can get up to the point where it's 50%, especially in California. 50%. And nobody wants the house. Nobody wants it. So you got to do you got to be a contrarian. You have to have mental toughness to do the hard thing, and that's to buy when everybody's selling and to sell when everybody's buying.
Are energy and power a big story right now?
They absolutely are, and everybody knows that. And I think oil's going to over $200 a gallon. And why is it going to over $200 a gallon? Because all this go green nonsense, that Biden's trying to shut down the fossil fuel industry.
You mean $200 a barrel, not a gallon?
Yeah, a barrel.
Although it'll seem like $200 a gallon.
You never know, Jim. That could have been a Freudian slip. Because it gets up to $200 a barrel, oil, because they're shutting down the supply side. You can't drill. They don't want you to refine anything. So pretty soon there's less and less and less oil, and everything's going green in their electric cars, And pretty soon, we're going to get to the point where this fairy tale is going to come to an end, where we're going to be able to rely on, renewable energy sources to satisfy our needs. In Los Angeles last month, I read a report where, the guy that's running the show up there, I don't pay attention to politics, he wanted everybody to stop recharging their electric cars at night, plugging them in and recharging them, because it was putting too much strain on the grid. Wait till the grid goes down and you're going to plug your friggin' electric car into it and there's no charging. That's the point where reality is going to come back and bite everybody in the butt. And that's the direction we're going. Because nobody wants to look at the math of this. Like, gee, is this mathematically possible that we can eliminate fossil fuels and still operate, our economies at the level they are now? The answer is absolutely not. No way. No way in the world. Not even close. I mean, how about a miracle happening? No, not even that. So that's the direction we're going, and it's going to get that energy. They're going to keep shutting it down where there's low supply, and then everybody's going to come to the realization, holy crap, we need this stuff. And there's going to be huge demand, low supply, oil's going to go over $200 a gallon, and everybody's going to be scrambling for it.
What's the water supply like in California?
I don't know. I turn on my tap and it keeps operating. And that's a good point, however, that I believe everybody, as a survivalist, should have 90 days of water and 90 days of food on hand. And I have 90 days of water. Everybody, you can survive 30 days without food before you die. You can only survive 3 days without water before you die. So if anything, get water. You have to have water. And so the way I figure it, I'm not going to be, go nutty about the thing, but if after 90 days that the world isn't back to normal, where we have water, then it's just every man for himself. Now it's like you got to be physically fit in order to survive and survive in this world. And I am physically fit. So, and we'll just see how that turns out. But I'm not going to have 2 years worth of water in an underground well or something with a pump, to get a hand pump to get it out. No. Life's too short for that stuff. But 90 days, I can live with 90 days, and everybody should live with 90 days.
Well, you have to go to one of those outdoor stores where you can get water purification tablets, little pumps that you can drink water out of a mud puddle. You just pump it out and it's purified. That's my solution. I have one of those.
Of course. We have those water purification tablets. Even if water gets old, put those purification tablets in. I'm even told that, if you drain your water out of your radiator and put one of those purification tablets in it, it won't kill you. But there's only so much of that water around, Jim. That's not going to last. You're not going to be able to scrounge for 90 days and survive, with those kind of tactics.
Of course, Bob, I live in a moderate temperature rainforest, and we have localized flooding happening, and the Fraser River, a block from where I live, is running pretty high. In BC, we don't worry about water that much.
Be a problem for you.
No.
Down here in Southern California, if we didn't get water from outside sources, we'd look like Baja California.
Mm-hmm. Bob, do you think a recession is likely?
Yes, I do. Hey, I'll tell you guys something that I just learned. My number one, all-time recession indicator is an inverted yield curve, where the 90-day T-bills goes above the 30-year T-bond. And I don't know that we've quite had that yet. Certainly the 2's inverted with the 10 and the 5's inverted with the 30. But one other historical sequence I've noticed is any time in the past 50 years when the month supply of new homes for sale gets above 9 months, we've had a recession. We're 4 for 4. Guess what happened last month, guys? 9 month supply in new homes. So I know we're going into an inflation. I know we're going into a recession. And I can, everything in life is a probability. Nothing's 100%, nothing's 0%. So with a high degree of certainty, based on inverted yield curves, and now this new real estate recession indicator I found that I've discovered, we're going into a recession.
How important are gold and commodities going forward?
Very, very important. I'm giving a live seminar on September 17th at the Hoye Marriott, and it's all based on the title of the seminar is How I Stopped Worrying and Learned to Love Inflation. And what you have to do during inflationary periods is you have to know which asset classes will perform the best. And those, historically, have been commodities and gold. And when I say commodities, I'm talking about agricultural commodities. I'm talking about industrial commodities. I'm talking about oil, gold, and silver. All of those things. Those are going to perform really, really well. And don't try to market time it, guys. Just take your positions, and we're just at the beginning stages of this inflation and this price appreciation with respect to commodities. You know, commodity prices have gone up like 50% in the last year or so. And a lot of people are saying, whoa, that's a big move. Is it time to take profits? No, it's not. It's not a time to take profits. It's time to accumulate more. Because what happened in the last year relative to what's likely to happen in the next 5 years, or maybe even more, it's insignificant. Commodity prices are going to double or triple from these levels if history repeats, which it tends to do.
Could gold save the world?
Yes, it could. As I previously explained, that when everything gets going bad and you have $30 trillion worth of debt that can't be paid back and nobody wants it, so everybody starts turning in their debt, and so that means a lot of supply, no demand, so interest rates will soar. The way to get the demand back, and to take the dollar, is back up with gold. 40% backed by gold. That'll do it. And how do you back the dollar with 40% gold? Can you back up with all the gold we have at $1,800 an ounce? No way. You have to triple the price. Put it at $25,000 or $50,000. It doesn't matter. But now you back it. All the U.S. government has to do is say gold's worth $50,000 an ounce, and that's the new price. And you back the dollar with gold. Now there's confidence in the U.S. dollar. Now there's confidence in the U.S. Bond market. It won't collapse. And now the economy can function again. So you won't have hyperinflation. That's the key again. That's how you stop hyperinflation. Back up with gold.
As interest rates are increasing, is debt servicing becoming more difficult?
Yes. I mean, with respect to mortgages, here in the United States, the average mortgage payment has gone up like 50-60% in the last 12 months. And that, of course, is why affordability levels are approaching, if not already exceeding in some instances, the old peak during the housing bubble. So at some point, here's what happens. People just can't afford a house. It's just a math problem, guys. It's not an arbitrary number. Like, gee, how high can the stock market go? Yeah, to some degree, that's an arbitrary number. How high can housing prices go? That's not an arbitrary number, because all of a sudden that everybody's spending, over 50% of their money on a house, and that just doesn't work. I mean, there are other expenses than owning a home. And a lot of expenses. So it comes to a point where pretty soon the debt to income ratio gets at such a peak, now the bank won't lend you any money. Bank says no. If the borrower isn't smart enough to say no in advance, no, we won't lend you that amount of money. To buy that house, I know you have 10% down and you want a $600,000 loan, let's say. Okay. And that's going to result in 50% of your income, going to housing expense. We won't allow that. We'll allow 40. So what does that mean? That means your down payment has to go from 10% to 20%. Nobody has that money, guys. So the whole thing shuts down. The whole thing shuts down. They just turn the lending faucet off. And that's what causes the trend reversal.
Your thoughts on U.S. Medicare and Social Security going forward?
Social Security, I'm not worried about. That's a relatively easy fix. Even if they just the trust funds for Social Security, even if they're running out of money, which they say they are, and the next 5 or 10 years, that's an easy fix. All you got to do is take retirement age from whatever it is now. What is it? 65, 66, 67. Add 2 years to it, and the problem's fixed. That problem's fixed. Social Security, on the other hand, is a totally different animal. Social Security is going broke between the years 2024 and 2026, guys. No more money. The medical costs are rising so quickly that it's going to eat Social Security alive. Eat it alive. And Social Security is like 5 times the expense of Medicare is 5 times the expense of Social Security. Maybe 3. Maybe it's not 5. Maybe let's call it 3. Whatever. It's bigger, and that's where the problem lies. See, that's a mandatory outgo for the U.S. government. Social Security, Medicare, Medicaid, and debt servicing. You can't get around those guys. You know, you can cut defense spending if you wanted to from $800 billion down to $600 billion and save $200 billion. Whoop-de-doo. You can't cut Social Security $1. You can't cut Medicare $1. So what the Fed's going to have to do is they're going to have to print money to cover it, and that shortfall is going to get added onto the national debt. That's another reason why your first line of defense is a breakdown in the medical system, is to take care of your body, guys. Don't need a doctor. You shouldn't need to go to a doctor, because that may or may not be there for you in the capacity that it is right now.
Where are the potential safe places to keep wealth going forward?
It's good. Of course, that changes over time. During a real estate upcycle, the safe place to keep it is in real estate. It's appreciating, and it's appreciating, and it's a good place for money. Same with stocks. But I'm much more comfortable with real estate because I know it better. That's one of my skill levels. So you keep it in real estate. In an inflationary time, you put it in commodities and gold, and less so in real estate, other than your house. Real estate doesn't perform as well as optimally as commodities and gold. So and of course include silver in there. And so that's where your money ought to be during the next 5 years.
Gun control is being pushed in Canada and the U.S. How important are guns?
Well, I think it's really important. I mean, one, it's a constitutional right to own guns. Let's start with that. So start there, and I think that, it just appears to me that all this crap that's going on, with everybody, mandatory vaccines and all this other kind of stuff, that this is intentional, that they're trying to shut the system down, where we turn into a one world government, and that's not going to work. And it seems to me that, no freedom of speech anymore. Of course, you can't speak your mind anymore. Oh, no. That's a threat to our country, as opposed to being a benefit to our country. And now it seems like the last straw would be to take away your guns. And I just don't see that happening. America has 350 million to 400 million guns. And all it takes, guys, is people like me, old school Americans, ex-military, to say, you're not going to take my gun under any circumstances. Give me freedom or give me death. And if just 1% of all Americans have the attitude that I have, that's all it takes. That's all it takes, and they're not taking anybody's guns. Go down to Texas and take away the guns from those good old boys. Yeah, good luck with that. How much are those guys going to get paid knocking on everybody's door? I'm here from the government to take your guns. That door's not even going to open. What's going to come through the door is a round of bullets. So there's going to be a whole new set of job openings that nobody's going to want to take, and that'll end that. They won't take away your guns. They won't do it because people wouldn't stand for it. They just wouldn't stand for it. There's enough, ex-military, good old boys, people that believe in the Constitution. And like I tell everybody, I just turned 75 years old. You don't want to F with old people, guys. You know why? Because the older you get, the less life in prison is a deterrent. And it's so true. So true. And there's a lot of guys, boomers, and they're ex-military. They're not going to give up their guns. They're not going to do it. So, that's not going to happen. So, maybe the whole thing turns into a revolution. That can't happen anymore? Right. Read a few history books. So, unfortunately, America's on the decline right now. We're soft. We're weak. And I sure hope we don't get into a shooting war with Russia, because we're going to get our asses kicked.
Well, who do you think looks stronger, the U.S. or Russia? Russia has who looks stronger, the U.S. or Russia?
Russia. Russia does. We're weak. I know kids that are in the military. I know a few Navy SEALs. And they go, what do you think of the U.S. military? They go, it's pathetic. It's pathetic. Now you can't even, during boot camp, you got to be careful what you say, so you don't offend the snowflakes. Do you think those Russian soldiers are like that? No, they're not. We get our butts kicked, unfortunately. And I was telling a friend of mine, he's in his early 20s, I said, you may get drafted to go into and fight in the war if we get into a war with Russia. And he looked at me and said, I'm not going, Bob. He said, I wouldn't go. And I understand that, He's not going to fight some war for the politicians. And I said, I said, I would go, but they wouldn't take me because I'm too old. And he looked at me and said, Bob, they would take you. So, because we're willing to stand up and fight. Most people aren't willing to stand up and fight anymore for what's right, for the country. My dad was a Marine in the South Pacific during World War II. He fought in Okinawa. Those were badasses, guys. That's the way Americans used to be. We're not those guys anymore. So, it's going to take that kind of attitude to win our country back. To, get these politicians out of there. Get, will you believe in law and order? Will you believe in the U.S. Constitution? Where all, it pays to vote. Voting's all not done by fraud. All the old school characteristics that made this country great. I don't know whether it's going to occur or not, but I'll be hopeful. I'll stand up for it. I'll fight for it.
Heading into the health department, you hired a personal trainer. What's the deal there, Bob? You're the fittest 75-year-old I've ever seen.
Yes, I am. Thank you. And I don't deny that. I've been trying to lose 5 pounds of body fat for 2 years. I lift weights. I run hills. I've been unsuccessful. Am I in good shape and strong? Yes. I'm still trying to lose 5 pounds so that age 75, I have 6-pack abs again. So I decided, doing the same thing over and over again, expecting different results, is, of course, the definition of insanity. So I hired a personal trainer. And we're doing high-intensity interval training, which means things like sprinting, doing planks, holding ropes and throwing them up and down, doing burpees, things we used to do when we were young kids in high school, burpees, doing that kind of stuff. And all this stuff that just makes you sweat like crazy. And I think that in the next 6 months, I'm going to drop 5 pounds, and I'm going to be so happy. And, I started thinking about the other day, personal trainers aren't cheap, as we all know. I don't spend my retirement money on anything, guys. And I looked at it and said, what's more important than health? 0. So spend the friggin' money, Bob. A friend of mine told me the other day, he said, Bob, he goes, I know you're a saver, and I know you live a good life and you're happy, and you don't need anything. He said, but you know how much of your money you're going to take to the grave with you? He said, spend it. And so we're going to spend it on health. And so I've hired a trainer, and we work out like maniacs. I went over to a high school football field yesterday, and I did 100-yard sprints down the football field. Did 10 of those. And I felt so exhilarated, guys, and which is going to lead me to a point. I felt so exhilarated, I almost went back in the afternoon and said, I can do this again. Wrong. Today, my glutes hurt more than you can ever believe. So you got to get in shape. But I always leave you guys with a health tip, and this is it. There's an old Russian expression, everybody. A wolf lives by its legs, and it's absolutely true. A wolf's body has to be strong and powerful in order to kill prey like deer and elk that is significantly larger than it is. Even more importantly, a wolf has to be fast and agile in order to catch up with a much faster prey. In other words, guys, in human beings, here's how this applies to human beings. Upper body strength makes you look strong. Lower body strength makes you invincible. And that bit of wisdom right there, if there's only one bit of wisdom that I can impart to you on how to make every aspect of your life better and how to help you perform at peak physical performance, that would be it. Take care of your legs. I just went to a high school reunion where, that everybody there's 75 years old, of course, just like me. My effective age is at least 20 years younger than everybody. People are walking, have canes. They have walkers. They're walking over in a stoop. And I still stand as erect today as I did when I was in college. And it's all about taking care of your legs, guys. It's your legs. Don't worry about your biceps. Screw your biceps. Take care of your legs, and then take care of your balance. One of the high-intensity things is taking care of your balance. You know, like jumping up on top of a piece of an object that's like 3 feet high. All those are leg muscles. And so that's where it's at. And you know what? If just one of you listening to this interview takes that at heart, I know I've succeeded in helping at least one of you. But that's what you got to do, guys. You got to take care of your legs.
How important is mental toughness, especially when it comes to entrepreneurs and investors in the stock market?
Absolutely. To be the best that you can be in life, you have to be mentally tough. How do you get mentally tough? The key to mental strength is physical strength. That's where it all starts. You can't be mentally strong if you're not physically strong. And why is being mentally strong important? Because life is going to dish things out to you that come unexpected and that can be difficult. And if you don't have the mental toughness to deal with those things, to overcome those things, you're not going to get very far in life. And where I've really learned that lesson, I'm studying Navy SEALs. Navy SEALs, they train here in Coronado, California. 6 months training. In a typical class, let's say, has 100 people, 100 guys that are invited into the Navy SEALs training class. 100. And there's not one snowflake in that crowd, guys. No wussies. Nobody. They're all tough guys. On graduation day, 6 months later, 15 of them graduate. Only 15. And it's not because they weren't physically strong. It's because they weren't mentally strong. All of a sudden, those guys are out there, with no sleep. They're cold. They're hungry. They're hurt. They're hauling logs around and boats around, just pushing them to their limit. And if you don't have the mental strength to deal with that, they don't want you as a SEAL. Because when you're in, those are the most, maybe the most elite fighting people in the world. And when they get into a situation and somebody says, "Let's go, guys," they don't want one guy that's going, ooh, my back hurts. Screw you. You're going. You don't even have to tell them that. They all go. And you got to kind of have that same mental attitude, guys. You have to develop it. And you don't have to be a Navy SEAL to develop it. Here's certain ways to develop it. Let's say you go to the gym and you're used to doing 10 squats and then you're exhausted. Do 11. Do one more. And I tell you, it works. It does that. I run hills. I started running hills about 4 years ago. I run up a 1/4-mile hill that's fairly steep, 15-degree slope. That's a pretty steep slope. So that when I first started, I could only run up it twice a week, and I was exhausted. I'd come home and have to rest a couple of days before I try it again. Well, one day I ran it, and the next day I felt pretty strong. I said, you know what? I'm going to go see if I can do that 2 days in a row. And I did. I did 2 days in a row. Then I tried the third day. I did it 3 days in a row. I ran up that hill 28 straight days, guys. It's all in your mind.
How can people find out more about your book and newsletter?
Okay, let's hear about my book and newsletter. My book, Timing the Real Estate Market, I wrote it in 2002. The principles I presented into it then are as true today as they were then. And my newsletter, the Campbell Real Estate Timing Letter, it's published once every 2 months. And it tracks 25 different housing markets, major housing markets in the United States. And you can learn about both if you go to my website, realestatetiming.com. realestatetiming.com.
Bob, thank you so much for being on This Week in Money.
Thank you for having me, Jim. Talk to you later. Bye.
My guest has been Robert Campbell, publisher of the realestatetiming.com newsletter. He was speaking to us from San Diego. Coming up, Wolf Richter next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to This Week in Money, Wolf.
Thanks for having me back, Jim.
Wolf, before we get going, can you tell us a little bit about Wolf Street?
Wolfstreet.com is my website, and it's free. It's open to everyone. There's no paywall. All we cover is business, finance, and money, and no politics. So, that's where everything I say ends up. And also, we have a very vibrant and fairly well-behaved comment sections with hundreds of comments in every article. So come check it out, wolfstreet.com.
Wolf, are government debt and rising interest rates on a collision course?
Yeah, that's an interesting question. We have had years and years of interest rate repression by central banks, and the Fed did increase interest rates a little bit in starting in 2015 through 2019, and then unwound those interest rates again. So now we are on a much steeper rate hike cycle. We have 8% plus inflation as measured by CPI, and the Fed has now declared as its number one priority that crushing inflation is going to be the biggest thing, and even if it would push the economy into a recession, it's no longer focused on economic growth, but it is all about getting inflation back down. And so these interest rate hikes are going to persist going forward, and they're going to go much higher. I don't know how high they will go. Maybe in the United States we'll have probably over 3% by the end of this year and higher next year. And so there's a lot of government debt that will have to be refinanced at these higher rates, and new government debt issued will have to be funded at these higher rates. And so the question is, how much of a burden is that on the U.S. economy? And interest payments have already come up, and they've come up because in the United States, we've added $7 trillion to the national debt in the last 2 years since the pandemic. That's a 30% increase in the national debt. And so interest payments have come up, even though the interest rates have been repressed to zero, and long-term rates via quantitative easing. And so despite the interest rate repression, interest payments have gone up. But the burden of those interest payments in terms of overall GDP, the economy, the economy grows with the population, and then grows with income and with profits, and it's grown substantially during all these stimulus efforts, as has inflation. So it's measured by GDP. The burden of this debt reached a low that we haven't seen since the 1950s of around 2.2% of GDP, and that's not the debt, but in terms of the interest expense. The interest expense in terms of GDP reached a low not seen since the 1950s of 2.2%. And during the Reagan years, it reached a high of over 5%. So we're less than half of that. And we're at historic lows, really, in terms of the burden. So, higher interest rates will bring up those interest payments, but inflation has the impact that wages go up. So you have wage inflation, so people are paying more in taxes. There's been a lot of profits due to asset prices, and so there's a lot of tax revenues from that. Corporate profits have been very high. So, there is a lot of additional money washing around in the economy, and so far, those interest payments are really a very low burden, and as we go forward, they will rise substantially, and as will the economy. So, not adjusted for inflation. None of these figures are adjusted for inflation. People will still make more money because wage inflation right now is very high, and there's more income coming in from other sources for the government, and taxes have been just streaming taxes, income taxes and other taxes for the government have been huge. So, that this will go up together. So interest payments will go up, and the economy will go up, and inflation will go up, and the tax payments will go up. So it will take a long time for these interest payments to be actually a much larger burden on the economy. And right now, the government is back down to increasing the debt at the pre-pandemic level. So the spike that we had, the 2-year spike, is now behind us. We're just back to kind of normal increases of around $1 trillion a year in the national debt. So the speed with which the national debt increases is back to pre-pandemic trend. And at the same time, we have much more inflation. We have much higher wage inflation. We have much higher income tax receipts than we used to have. So I don't see that as a big problem over the next few years in terms of the burden. What I'm hoping for is that eventually it will become a big burden, enough so that we have some significant discussions in Congress how to address the national debt, because over the long term, that's not a good situation to be in, and there has been no discussion seriously in Congress because we have had interest rate repression. Money has been free. The government has been borrowing at near 0% short term and very low rates long term. And so nobody in Congress wants to really discuss this. There's a little bit of tongue wagging by a few people, but generally it just gets wiped off the table, and it's not even an issue. And that's a problem. And interest rates mean this is cost of capital. And the capitalist system needs that discipline of cost of capital. And if cost of capital is free, there's no discipline in the capitalist system, and it goes haywire. We've seen that. Now we've got a capitalist system that's gone haywire, in part due to the cost of capital having been artificially repressed. And it would be good for the overall economy. It would be good for decision making. It would be good for politics if the cost of capital becomes again a significant factor in decision making at all levels. And so I'm kind of hoping that will happen. That used to be the case, and a lot better decisions are made when there's a significant cost of capital, and that's in terms of politics, but it's in terms of capital allocation in businesses and households. So this is really something to look forward to. I don't dread this. I think this is an important feature of our economy and political process, that form of discipline that comes with higher interest rates. And so, and unfortunately, we're still a long ways off. This won't happen for years, but eventually it might be a factor, and then I think it will be a good thing. This economy needs higher interest rates. Our politics need higher interest rates. We need this cost of capital to be an influence in the decision-making process all around, and so I'm kind of looking forward to that.
There's been some talk recently about an inventory glut at retailers, going from shortages to overstocked in no time. What's going on here?
Yeah, that's interesting. You see a lot of financial types talk about this because in dollar terms, inventories have ballooned. But when you look at your own industry, at inventories, you don't look at it in dollar terms. You look at it in terms of units or supply. So, for example, housing inventories is not really ever discussed in terms of dollars. And vehicle inventories is by insiders, is not discussed in terms of dollars. It's discussed in terms of vehicles in stock or in a month supply. And the same thing in all other industries. So when we look at it on this basis in terms of month supply, inventories are still woefully low in the auto industry. So in terms of new vehicle dealers, we have historically low supply in terms of month supply. In terms of millions of vehicles in stock, which is barely over 1 million vehicles in stock in the United States. In stock means also in transit, so vehicles that haven't even shown up on the dealer lot, and it includes vehicles that have already been pre-sold. And that's down by 70% from pre-pandemic times. So we used to have between 3.5 and 4 million vehicles in inventory. Now we're just a little over 1 million. It is just a horrible situation. You go to a Toyota dealer, they have nothing for sale there. You have to order it. You have to wait months to get it. The same with Ford and many other brands. So, this is a situation that is in terrible shape still. Used vehicles, we have more inventory, but it's still relatively low. Normally we would carry in the United States around 3 million vehicles in inventory, used vehicles. Dealers are down to about 2.5 million now, so there's no real shortage there, but it's relatively on the low end. Supply has come up a little bit because sales have plunged in the vehicle sector because there's just not a lot to sell right now. And auto dealers make up over 1/3 of all retail inventory. So that's the biggie. Auto dealers are the biggest part in this, and they're really struggling to get inventory. Now then we have in the food and beverage stores, we had the shortages during the pandemic when people walked into a shop and a grocery store, and you saw all these empty shelves. And then people would hoard, and they'd run out, and the stores would run out of toilet paper and all this stuff, and you couldn't get pasta, and it was just ridiculous. So finally, grocery stores have caught up. Their inventory in terms of day supply is at the low end of where it was before the pandemic, but it's back in the normal range, but at the low end of the normal range. And thank goodness, this is, you still run into a few shortages here and there, but generally, that you can buy what you want. And, with food and beverage stores, that's really what we want. We really don't want to run out of inventory there. And inventory means, it's a pipeline, so there's warehouses and there's trucks and there are containers and then there's the back of the store and the shelves. And there's a constant flow, and inventory means that amount of merchandise that's now flowing to the shelf and it's on the shelf. And so we're in a situation where I'm no longer worried about running out of stuff, but we're not overstocked at all in that segment of the business. Now, in building materials and garden supply retailers, so that's at the Home Depots and those kinds of the stores, we're in the normal range, maybe a little high for some. For this season, we're definitely back in the normal range. Time it's in 2019. Retailers usually stock up for it. You got a lot of gardening projects coming on in the spring and summer. So we're back there in terms of day supply. We're right back there where we should be, I think. In clothing stores and accessory stores, inventories are still low in terms of day supply. They have not recovered. They're far from recovery. They're stocking up, but they're having trouble getting stuff. So, and sometimes they ordered the wrong stuff. Consumers move on. It takes the containers get caught up somewhere, and it takes many months longer than it should be. And when the containers finally get in, the consumers don't want this stuff anymore. Now they want something else that you don't have, and you run out of those things. And there's a lot of that chaos going on. Retailers order something, it doesn't arrive for months. It gets hung up, it doesn't get made. There's lockdowns in China and whatnot. And there's container pileups. And so when you finally do get it, it may be too late. The consumers moved on, and we have that chaos. But overall, in the clothing stores, their inventory is below where it should be, and they're out of stuff, and they're overstocked and stuff that consumers don't want anymore. And you have got that problem too. And then you have the general merchandise store. So that's Walmart and Costco and those places, and they have a problem in that got caught by the chaos. So they ordered for pandemic demand for working from home, from not doing stuff, and then the economy opens up. That stuff that they ordered finally gets in after having gotten hung up somewhere for a long time. And they finally get the stuff, and now consumers want to travel. They're out there. They need luggage. They need traveling clothes. They want to dress up again to go out to parties, and some of them go even back to work. And suddenly that stuff is not there. Now they've got all this other stuff, the work from home stuff that consumers don't want anymore. They've had enough of it, and now they're looking to buy other stuff. And the big thing is luggage. People want to travel, and now stores ran out of luggage. And so you have this disconnect there, but overall, in terms of inventory sales ratio, at these stores, inventory has shot up quite a bit. It's now the highest it's been in several years, and it's higher than these stores want to be. They've complained about it. Walmart complained about it. Target complained about it. So they're the category of stores that have gotten wrong-footed there and that just misordered, which is a big thing in retail. You normally keep your supply chains really tight and short, so that you don't have long lead times between the time that you order and the time you get the merchandise, so that customers, you understand what your customers want, that you can supply them. And this got totally screwed up during the pandemic. Instead of being able to get your merchandise in a few months from the time you make the decision, it took a lot longer, and so now they have the wrong merchandise, and they're out of stuff that they could sell, and they're sitting on stuff that they no longer can sell, and so the inventory sales ratio is high because what they could sell they don't have, and so they don't get the sales, but what they do have they can't sell. And they have to put some of the stuff now on sale, cut the prices, and then that's a classic retailer issue. That's what retailers try very hard to avoid, and so they've gotten into that, and so you hear a lot about that. What you really hear is Walmart and Target and those kinds of stores, and having finally gotten the wrong merchandise and running out of the stuff that they could really sell. And overall in the retail segment, as I just mentioned, there are parts of it, big parts of it, they're woefully undersupplied. And there is, this is general merchandise stores. It's about 10% of total retail, and a portion of that they're oversupplied. And that's the mix. And overall, the retail inventories in terms of day supply are still far, far below the pre-pandemic normal. We're now looking at roughly, a month and a quarter in terms of supply, when it used to be over 2 months. And it just, it just takes a while to get all this sorted out, and there's a huge amount of chaos going on, and inefficiencies and delays, and this whole supply chain stuff is going on and hitting the retailers, continuing to hit the retailers, it will take quite a while to get this whole retail situation back to normal.
Does cutting back on the inventory of new vehicles available make the automakers more profitable?
Well, in theory, that would be the case. Nobody likes to carry excess inventory. Now, the automakers don't really carry that inventory. The dealers do. And so the automakers manufacture these cars and invoice the dealers. And then, before the car even gets off the assembly line. And then the dealers carry the inventory, and so the inventory that sits around is generally on dealer lots or in transit. Now, we've had a huge issue with chip shortages and certain parts not being available. So automakers made hundreds and thousands of vehicles that were almost finished but lacking a part. And so they put those on storage lots. And then when they got the part in, they would install the part and send the vehicle to the dealer. So they've had those kind of inventory issues, but that's very unusual. So now what we have is Tesla. And Tesla has decided that it does not want to use dealers from the get-go, and it applied for an exemption to the state franchise laws that we have in the United States. So all the other automakers have to adhere to the state franchise laws, which require dealers, and these automakers cannot sell directly to consumers. They have to go through their dealers, and that's protected. The franchise laws protect the dealers. And Tesla said, no, I don't have any dealers. I don't want any dealers from the beginning. There's nothing to protect. So we want to sell direct to consumers. And they've gotten that permission from many states, not at all. So Tesla still cannot sell in all states, but they can sell in most states. And they've got this exemption. It's a very profitable way of selling cars because you don't have to deal with the dealers. You can sell direct. You cut out the dealers. You cut out the dealer profit margin, and all the other things you have to deal with when you deal with dealers. And so that's an approach that automakers would like to pursue in general. and they've watched Tesla get away with it legally, and so they're, other automakers, Ford's trying to talk about it, but you get a revolution among your dealers and you get sued. It violates the state franchise laws. So it's unclear to me how they're going to do this. But, Ford's making noises about that fairly clearly, and Volvo did too in California, and they got sued and had to backtrack and a while ago. And, so Ford is now saying with its EVs, it wants to sell more direct, and this is going to get carried out in the courts, I think. The dealers are not going to let Ford sell direct to consumers. That's just not going to happen. And so Ford will maybe sell to consumers directly, but they still have to go through the dealer to pick up the vehicle, and the dealer still gets a cut. So it still will be you can't cut out the dealers, and so there will be an effort to do this, and then Ford will avoid the problem of having to supply the dealers with inventory. They can build directly for the consumers and ship the vehicle to the dealer and let the dealer deliver it to the consumer, and Ford will have to give the dealer a cut. And so it will be this kind of hybrid situation, but it will be much more efficient. If he can get American consumers to order vehicles instead of picking one out of the lot, that would be a huge change in how Americans are buying vehicles. And that's it's gotten to be fairly common now, because there's nothing on the lot. You can't buy anything off the lot. So you have to order it, and then you have to wait 2 or 3 or 4 or 5 months or longer to get it. And a lot of customers are now getting used to buying that way. And that is, of course, a lot more profitable for automakers, because they can build for direct orders. They don't have to speculate what might sell. And so if they can get through to American consumers that instead of going to the lot and buying something on impulse, they will order it and then wait for 3 or 4 months and then take delivery. And if they can pull that off for at least part of their sales, that would be a much more efficient way for the entire manufacturing process. You're building for a fixed order. You get this vehicle in the order bank, and they're building it for you, and you don't have to promote it once it's manufactured. You already have a buyer for it. So, I think that's the way to go. If they couldn't have worked a car dealership ran one, for a decade, and I always thought it's an archaic way of doing business. But it's a very profitable way of doing business, and there's thousands of dealers, and these are independently owned businesses, most of them, and you can't just throw them out of business. So they're protected by these franchise laws. So I think it will take years to clear up, but I think there's a way to make this process of selling new vehicles a lot more efficient, and and I hope that will make some progress, because outside of dealers, nobody's really happy with the system that we have now.
What's happening with new and used autos and EVs?
Well, we don't have the June sales numbers yet. So Wednesday, we're June 29th now as we're talking. But they're going to be really bad. They could be down 15% or somewhere in that range to 20% from a year ago. That's been the same for months. There is not enough new vehicle inventory. Practically everything has to be ordered, and that takes a long time. And so this whole flow of merchandise has just slowed down. Used vehicles have gotten so expensive that there's now a buyer strike going on, and dealers are not really cutting their prices because they don't have enough inventory to worry about it. So, sales volume in used vehicles is down also, and dealers are making a lot of money because the prices are so high. There's a lot of frustrations among buyers because they can't get what they want, or they have to pay a huge amount for a used vehicle. And now interest rates go up, so we've seen auto loan rates go over 5% now, and so that makes the purchases even more expensive. The lease terms are getting tightened up. Now Ford and others are no longer doing buyouts at lease end, so the vehicle goes back to the automaker. And that is because the lease buyouts used to be incredibly profitable for customers during the last 2 years because used vehicle prices have shot up. The buyout value is determined at the beginning of the lease, and 2 years later, used car prices have skyrocketed, and you can buy out the vehicle from the lease and sell it for a $5,000 profit in the used car market. And so they're doing away with that, and that's changing everything. The incentives have been cut to record lows from the automakers, so there are no good deals available. Dealers are still charging over sticker for a lot of vehicles. And this is a very frustrating phase for the industry right now. The dealers can't get enough merchandise. The customers haven't paid an arm and a leg to buy something. If they buy new, they have to wait, they have to order it, and they have to wait. And the shortages are everywhere, and it's a frustrating time. At the same time, the prices are incredibly high, so the profit margins are huge for the dealers, except they don't have enough volume. So the unit volume is way down. The profit margins are way up. But overall, there's just not that much activity, and so that's a bad deal. It's not a good time to buy a car. I would just wait until this shakes out. This is a terrible time to buy a car, new or used. Those prices have to come down. The inventories have to come up. Most people can drive what they already have for another year or two, or for another 5 years. It's really a good time, I think, to just let this stuff settle down and let some rationality get back into that market. And that it needs to be supplied properly. Now we have a supply shortage that's an incredibly difficult thing to deal with for the whole industry. And so the best way to deal with a supply shortage is just to not buy. And that will solve the supply shortage. And we're seeing some of that. You'll see the June sales numbers come down pretty sharply from last year, and they will go forward. It just, at this point, people just need to back off, I think.
How much further can gasoline prices rise?
Oh, good question. They're already at $5 on average in the United States. In California, regular is already over $6. And we have seen demand destruction. So that's the term that is used when high prices cause demand to decline. That's an economics phenomenon. A different way of expressing it is that a high price solves the issue of high prices, and meaning that a high price will cause demand to fall, and then the prices will have to come down. And we've seen demand destruction. We've seen this happening starting earlier this year, and gasoline demand has been down between 4% and 6% every week this year so far from the normal period before the pandemic. Gasoline consumption in the United States is already a flat business. It peaked in 2007 and then on an annual basis, then fell, and then it came back to that peak in 2015, 16, 17, 18, 19, and just kind of stayed there, and now it's plunged from that. Vehicles have gotten more fuel efficient. Even pickup trucks have gotten a lot more fuel efficient. Now we've got the influx of EVs. All the legacy automakers are now offering EVs. They're taking off. Every EV you can buy is sold out there. And, so gasoline consumption is permanently going lower. And, the refiners, the oil companies know this, and they've talked about it. Chevron and Exxon, they've all talked about this. Their gasoline is not a growth business anymore. It hasn't been in the developed world, and it hasn't been in Europe. It hasn't been really anywhere where the auto industry is mature. And so this is a declining business, a long-term declining business. They have not invested in refineries because it's a declining business, and you don't throw lots of money at a declining business. Now in the United States, we've become a massive exporter of gasoline. We've already been that for years. In California, we import crude oil and refine it and export gasoline and diesel and jet fuel to Latin America. It's a big business. I see the tankers go out here. I'm in San Francisco, so I see the tankers go out from those refineries around the bay, and they're heading south to Latin America. And it's refined from imported oil. And so the United States has become that exporter of gasoline, and we've got our own crude oil production in the Gulf region where gasoline gets exported from. And so there's this demand from other countries now drawing on the United States gasoline production, and that's been going on, but it exploded this year. So I shouldn't use the word explode when we talk about gasoline, but the demand exploded. It's up 20 to 40% from a year ago, and it normally declines exports normally decline in the summer during driving season because there's more demand in the United States. It normally increases in the winter, and this summer it's continued to be very high. So the exports, even as domestic consumption declines, exports have ballooned. And so that has put upward pressure on gasoline prices, even as consumption has declined in the United States. So we have this issue that demand is not just local; it's now international. And with the issues in the Ukraine and the embargo on Russian petroleum products, we have more demand for U.S. gasoline. And so the prices have continued to go higher despite the declining demand. And the question is how much further can they go? And at some point, there is going to be a much bigger decline in demand in the United States, and there will be a decline globally as gasoline prices go higher. And at some point, it just doesn't. People switch to alternatives, and including electrical vehicles and mass transit and walking, riding bicycles, etc. And that demand destruction can be pretty severe, and some of it is long term, such as the switch to electrical vehicles. And it won't be reversed. It'll just continue. And so I don't, gasoline can probably go up another $1 or something, but at some point, the demand destruction is going to be so massive that even with exports rising, it just can't go much further. And now in terms of demand for petroleum in general, there's only a part of it goes to transportation fuels. The rest goes into the petrochemical industry, and there is large-scale demand growth there. All kinds of things, plastics and all kinds of other stuff. And a good recession, a big recession globally would curtail that demand on the non-transportation use of petroleum, and it would bring those prices down somewhat. But I still see some room to grow for gasoline prices. This is just in the United States. This is just we're now tied to the global markets, and there's a lot of global demand for U.S. gasoline, and demand destruction in the U.S. is going to have to become much bigger before it will bring down prices.
With all of the many parts that make up a new vehicle, why haven't the automakers solved the chip problem?
I don't know either. The chip problem is not just automakers; it's appliance makers, it's consumer electronics makers, it's everywhere. Appliances in particular. Home builders can't get enough appliances to finish the homes. And the chips are in everything. And there's been a huge explosion of demand for goods and durable goods, and a lot of them have chips in them. And during the pandemic, with all the stimulus going on, it just cost an enormous amount of demand on chips. And I'm talking about, low cost, trailing edge semiconductors that were, designed many years ago that are built in aging semiconductor plants that nobody invested any money in, and they go into relatively low-cost products, into switches, into different things, and sensors, and cars have thousands of them. And if you just short of one of those chips, you can't finish the car. And so this is a massive issue for automakers because they have such a variety of chips in these cars and the components, and there's hardly anything that operates on a car that doesn't have a chip in it. I mean, your trunk lock, everything, your windows, your power windows, your mirrors, and everything has chips in it. And you miss one, you run out of one of these chips, and one of those components can't be made, and you can't finish the car. So that's what makes the auto industry particularly susceptible to this, because it's such a complex industry and the supply chains are very long. They go all over the world, and it takes a long time to redesign components around certain shortages. There's software involved, there's hardware involved. So this is a very difficult process for the industry to deal with, and some automakers have done a little better than others. But it's an issue globally. Now we've had, for European automakers, we've had the issue in the Ukraine, where a lot of the wiring harnesses are made in the Ukraine, and so they've had problems there. So you can make the cars, but you can't install the wiring harness. And, so there's other supply, issues for the auto industry that are unrelated to chips. It's just been a nightmare for the industry, and it's supposed to get better. It's supposed to have gotten better by the end of 2021, and it didn't. And so now it's supposed to be getting better this year, and it doesn't and isn't. And now the people are talking about, the industry people, that the chip makers are talking about that they may be able to catch up by next year. They have to build new plants. They have to. You can't even get the equipment to make semiconductors because you can't get the semiconductors to make the semiconductor manufacturing equipment. So it's just a nightmare all around. And eventually, they build enough capacity, and there'll be a glut of chips. We'll get that. I mean, it's predictable. The chip industry goes through that, so they'll invest lots of money, and then eventually there'll be a glut. The crypto mining has a big hand in this. They went on to a boom. All kinds of crypto mining equipment was purchased to have lots of specialty chips in them, and that. And those are high profit chips, and so that took a lot of capacity to build, and I would love to see this normalize, and I mean that's a big issue, but I don't think we're going to see it normalize this year. It looks like maybe next year.
Housing bubbles in America, where are they, and how big are they?
Well, they're huge. Free money does that. Same in Canada, and they're starting to unwind. We've seen, they've talked about this housing shortage, and now this housing shortage is starting to come on the market. We've seen houses, homes, condos, everything just pile up now, and the inventories are surging. And I mean, it's in San Francisco. I just looked at my zip code yesterday. There's 140 homes for sale in my zip code, and it's a huge number suddenly. They're everywhere. And we see that in all big markets. So the dynamics have completely changed. The housing shortages. I mean, these people own 2 or 3 or 4 homes that didn't sell them, so now they're putting them on the market. And interest rates, mortgage rates, if it's 6%, our 30-year, our benchmark 30-year mortgage rate now is around 6%. Suddenly, it's double, so the home prices that made partial sense at 3% become unaffordable at 6%. And so you have a lot of buyers, get pushed out of the market. So the housing bubble, the price bubble that we have is now running into these issues. And the price bubbles were huge. And in a lot of these, cities, we've had, price increases of 30% or more in the last 12 months. And you go back to 2 years, and there's price increases of 50%, in 2 years. And, this is completely nuts. And they weren't cheap to begin with. They were already at very high levels. And these prices can't be, the math doesn't work out anymore, because now at 6%, these prices are unaffordable. And for home sellers, who want to sell their homes, they're facing buyers that are constrained by these mortgage rates, and the cash buyers, they see that too. The cash buyers are not stupid. They're very smart, and so they don't feel like overpaying either. So you have sales that are coming down. They've already come down a whole bunch in the last few months, and they will continue to come down. So, those housing bubbles that we have are unwinding, but they're just gigantic. You're looking at 30 to 50%, 60% in some cities in a 2-year time span. These are price increases that are just ludicrous on top of already high prices. You're looking back at a 20-year time span, and home prices have in some cities have gone up by 300 and 400%. And in 20 years, when CPI, the consumer price inflation, has been maybe 70% of the same time period, and wages have gone up in the same range. So it is not sustainable. We're finding that out now. The housing shortage is over. We have all sorts of inventory now come on the market. Sales are down. So, this is turning around.
Are you buying cryptos on the dip?
Moi? Me? No. I'm waiting for this to go away, and much of it has gone away. 2/3 of it has already vanished. A bunch of cryptos are at zero or close to zero. The DeFi industry, the crypto outgrowth that provides leverage and sort of crypto banking, is imploding right now as we speak, with one company after another collapsing and shutting down and locking out people that have their cryptos in them. And NFTs, they're blowing up. So I'm just gonna sit there and wait for this thing to go away, and I don't even cover it anymore because I'm tired of it. This is an enormous amount of speculation and scamming that's been going on there, and it's a sordid part of the everything bubble. Lots of people will unfortunately lose lots of money. I have already. This stuff has lost 2/3 of its value. What little is left out there, and I feel sorry for these people that are gullible enough to go for it. And but that's how bubbles work. That's how that works. And I'm not buying the dip. I'm just waiting for this thing to go away and leave me in peace. And I think we've made good progress in that direction.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Bob Hoye, Robert Campbell, and Wolf Richter. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howestreet.com. Now stand by for a company showcase update from American Manganese CFO Shaheem Ali. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Shaheem Ali. He's the CFO at American Manganese. Welcome back to the show, Shaheem, and happy Canada Day.
Thank you, Jim. I'm happy to be back on your show.
And, of course, happy July 4th for our American listeners. And you were in the American capital last week for a Gigafactory event. Can you tell us about it?
Sure, Jim. A lot of interest came in from our listeners on what was Battery Gigafactory event all about in Washington, D.C., and what all happened over there. But first, I wanted to respond to some comments on Larry's plan on the drill program that was shared recently on your podcast. The drill program was designed and budgeted last year. But due to forest fires and air safety, we had to actually postpone the project. The drill program was designed within the budget, so we don't have to go out there and raise the money. It was all planned out. However, just to make our listeners aware and our investors aware that the drill program allows us to better position our real estate for the mineral property option agreements or deals potentially out there. There is no intent to be a gold miner, but have a better value option on the assets for our investors. That's all. And yeah, lastly, actually most importantly, last week I was at USA Battery Gigafactory event in Washington, D.C. The average lithium-ion based cell cost is now over 100 kilowatt hour, and the cathode now makes over 50% of the cost of lithium-ion batteries. This event attracted actually many from battery mineral supply industry, the U.S. government administration and policymakers in one place to align how we can secure the most critical materials of the 21st century. It was very clear, Jim, from the U.S. policymakers and the administration that reshoring critical battery minerals and refining them locally was important, and the need to building sustainable, resilient battery materials supply chain economy in the USA, of course with the support of partners like Canada and a few others. I can tell you North America has very ambitious milestones towards electrification. We are trying to do things in 2 years, whereas Asia has been at it for over 10 years. The corporations attending the event echo the same sentiments, but very clearly their concerns are and challenges ahead are somewhat like it's taking too long to get permits, high environmental standards, the CO2 footprint studies, and the fact how do we scale with speed and in a responsible way. A lot of chatter happened around intellectual property being outside of USA. We want to do all of this great stuff, but the knowledge and the technologies reside outside of USA, mainly in Asia. They have about 80% of this knowledge base over there and doing it for over the last 10 years. Anyways, I can go forever on this topic, but main question is what's in it for Recyclico? One of the main points that was paramount at this event was that all of these must be done with the highest standard of ESG, or you are out. Simple as that. That is, environmental impact, must have low CO2 footprint, doing it socially and responsible way, traceability of materials, and best of governance. And battery recycling, upcycling, the green metals will be the big part of this ESG. I'm met and connected with government officials, industry analysts, and many potential affiliates in this space, all with the purpose to move Recyclico forward and to ensure we are known in the industry. This visit also allowed us to make inroads with inner workings of the critical metals and minerals industry. I'm happy to say that a lot of battery manufacturing and refining facilities are planned for North America. And most importantly, the U.S. government is willing to work with all of us. Some bullet points on what is happening here at the office. Just want to address a few of those that has come through our listeners and my emails and LinkedIn. Keep it coming, by the way. The cathode precursors, NMC 811 materials that we send to a third party, I wanted to share that it takes time to assess these materials. Current efficiency and tap density, morphology, and many more variables are being tested as we speak. As for the demo plant, I know it is taking time to build the demo plant, especially in today's economic climate and supply chain delays, but rest assured, we are at it, trying to doing it right. I received an email about an hour ago from our Environmental Impact Life Cycle Assessment group. Our LCA is going through final sign-off today, and delivery of the report is now any day. I'm pretty much off the cuff. I can say it'll be here tomorrow. Look out for that press release soon. The way I look at it all of these EV batteries will be dying to do business with us. We just have to be patient, and our time will come.
Shaheem, for people who want to know where you're traded and how to get more information, where should they go?
Sure, Jim. We are traded on TSX Venture Exchange, AMY.V, and an OTC QB, AMYZF, in U.S., Frankfurt 2 a.m. You can reach us at 778-574-4444. Visit us on AmericanManganeseInc.com, or you can email me at Shaheem@AMYMN.com. Finally, Jim, on behalf of our family here at American Manganese, soon to be Recyclico Battery Materials Inc., I wanted to wish all our listeners and our shareholders and their families a very happy holiday on this long weekend, Canada Day Friday, and Monday, 4th of July in the USA, Independence Day.
Shaheem, thank you so much for the update.
Thank you very much.
My guest has been Shaheem Ali, CFO of American Manganese. I'm Jim Goddard. Our conversation took place on June 30th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.